Alright guys, what's going on? This is Daniel, one half of the Kwak brothers, and in this video we're going to talk about what is a good return on a rental property. Cue that intro, let's get right to it. Alright y'all, welcome back. What is a good return on a rental property, right? That's a question that I get a lot. That's something that I think a lot of people talk about. So before we begin to the topic, of course, never forget to click that subscribe button and click also on that notification bell. We put out a lot of great real estate investing content in terms of more specific content now. And like real estate, right, it's helpful to be the first person there at the table with the seller. So like that, practice that philosophy here by clicking on that notification button and being the first to get our videos and be able to learn it and hopefully use it to put some money in your pocket. All right, guys, so it's something that I get asked a lot. What is a good return on a rental property? And well, I've had a lot of opportunities to analyze a lot of different deals, So I've done over, I think now I've got like 80 something units, and I'm doing a lot of different deals around the country and raised a lot of money. So it's something that I've done rather often. And in my experience, the answer to that question of what makes a good return on a rental property is it depends, right? Now, I know you guys are ready to shut off this video, find out where I live, and just, give me a nice sucker punch in the throat. But in honesty, guys, I know as much as you guys may be maybe sick and tired of hearing those two words, it depends. It is absolutely true. It does depend. It depends on what you're looking for because, well, there's different things that rental properties offer in terms of a return, right? So when we're talking about what makes a good return on a rental property, there's a lot of things we have to keep in mind. So let's go ahead and use an example, right? So let's say that we have a 10-unit building. So we have 10 units. And let's say that we buy it for $800,000. So we bought it for $80,000 a unit, and let's say that the net operating income, right? So that's the NOI. NOI stands for net operating income. Let's say it makes $80,000 a year. Now, obviously, that's not the cash flow because we still have to deduct our debt service from it. But I want to show you guys basically that there are 4 different ways to get a return from a rental property. So, hopefully as I break this down and I explain the different ways that you can get a return on a rental property, you can then decide based on your own financial situation, what is a good return on a rental property. For some, it may be the cash flow, maybe something else, right? So it completely does depend. So the first way obviously is the cash flow. Right, and how good is the cash flow? Right, a pretty good number is to kind of stay above 8% cash on cash return. So what does that necessarily mean, right? So let's go ahead and break that down. So in order for us to calculate what our cash flow is, we already have our net operating income of $80,000. We have to know what our debt service is, because unless we know what our debt service is, which is the mortgage, we're not going to be able to figure out how much money there's going to be left for us, right, to call it cash flow. So I'm going to go ahead and calculate the mortgage. And one of my favorite mortgage calculators to use is Karl's mortgage calculator. That's Karl''S mortgage calculator. I'm going to put in the value, which is $80,000. And let's say in this scenario, we put 20% down. So we put $160,000 down. I'm going to just use 5% interest because the going rate's 5.5%. If you're an expert investor, you should be able to go in the bank and get 4.5, 4.6. So I'm just going to kind of meet in the middle and just say 5%. And I'm going to put it on a 30-year amort because that's what a lot of people are doing nowadays. I personally prefer a shorter amortization because I like paying off properties quicker rather than later. But for the sake of the example, I'm just going to go ahead and use 30 years. So our debt service is $34,3566. So I'm just going to use $3,400, just round down $35, just kind of use cowboy math. And I'm going to go to my calculator and I'm going to multiply 3,400 and multiply it by 12. That gives me an annual debt service of $40,080. Okay, so if I subtract $40,080 $800 from the 80,000, that's going to give me my cash flow. So I'm going to subtract 80,000, 40,800 from 80,000. And that puts us at $39,000, $39,200, which we divide that by 12. That's our monthly cash flow. $32,66.66. Right? So $3,266.66. That's our monthly cash flow. Now, if we want to take it a step further, we can go ahead and compare that to the down payment that we put in terms of our investment to acquire the building, and figure out, what is the return, right? What is the cash on cash return, right? So I'm going to go ahead and take $39,200 because that's the number annual debt service before, that's the cash flow before we divide it by 12. I'm going to divide that by 160,000, and that gives us a 24.5% cash on cash return, right? Now, obviously, you can have an investor be in it with you who provides the 160,000. If you split the deal 50-50, that gives your investor 12.25% cash on cash return. Another way for you guys to make a return on an investor property is the amortization, right? So the amortization is the principal that you pay off through your debt service, right? So I'm gonna go ahead and look at here in my table, right, in my Karl's mortgage calculator, and I'm gonna see that in 2000, right? So if I did this deal today, right, my first full year of paying this off, I'm gonna pay $9,761.71, right? In terms of my long-term efforts, right, that's what I like. I like paying off that amortization. I like paying off that principal. But now remember, guys, we did it at a 30-year amortization. So let me go ahead and change that to 20. And in 2020, get this, guys, right? So in a 30-year amortization, in 2020, the very first full year of us owning this property, we paid $9,761.71 in principal. If we did it at a 20-year amortization, that very first year, we paid $19,765.46. That's more than double if you did it at a 20 compared to a 30. So now this is where the answer of it depends start to make more sense. If you're somebody that's more focused on long-term finances, and let's say you have a lot of cash flow already, you're working a really high-paying job, or you're a full-time investor and you're already kind of financially free and you're not hurting for money right now, then in that case, you would need to get the 20-year because you want to be able to pay off more principal and get that long-term gain, right? That long-term wealth, build that off and get it paid off and enjoy it then. But if you're somebody that's hurting for cash right now, well, get $9,670 because that's literally a difference. You're sacrificing the amortization for the sake of cash flow, which is money today. Another way is appreciation. Appreciation happens in many different ways. I'm not going to get too much into it because, well, there's a lot of different ways to appreciate it. For example, there's passive appreciation, there's forced appreciation, there's phased appreciation, and there's also earned appreciation. There's 4 different ways to appreciate the value of a property. I'm not going to get into it right now, but I will make another video talking about the 4 different ways of appreciating properties, especially return on rental properties when we're talking about and answering the question, what is a good return on a rental property? The last one I'm going to talk about is the depreciation. The depreciation, long story short, is the tax benefits of owning rental properties. And the way you do that, long story short, guys, is you take the value of the building and not the land. Because remember, guys, land is not depreciable. You cannot take advantage of depreciation on land. So if I were to get this thing for $800,000, and let's say that the building value was $720,000, right? So 10% of the purchase price is for the land, rather than the building. What I'm going to do here, I'm going to divide that by 27.5. Why 27.5? Well, that's actually the life cycle of how long the IRS is willing to let us, real estate investors, depreciate the building. So we're going to take that number because we're able to depreciate it for 27.5 years. I'm going to take that 720,000 number, which is the value of the building, because of course the building is what we're able to depreciate. I'm going to take that number, I'm going to divide it by 27.5. Okay, that gives me an annual depreciation of $26,181.81. That means I get $26,181.81 worth of depreciation, worth of tax advantages, right? And for a lot of individuals like who I work with a lot, doctors, the depreciation means a lot. And for a lot of individuals, right, for a doctor, let's use a doctor as an example. Let's say they make a lot of money. They make $500,000 a year, right? In that case, they may not care about the cash flow as much or even the appreciation as much. They might be more focused on these two instead. Compare that with an entrepreneur who's 30 years old. They've got, let's say, 4 kids, and they got into real estate because they want the cash flow. They want the passive income. In that case, this is not going to be as important as to this, right? So what makes a good return on a rental property? Well, it depends. It depends on who you are, where is the building, and what's your exit strategy, right? Now, we can get into a lot of different topics here. We can talk about how the economy can change a lot of these returns. For example, the economy can change a lot to the cash flow because, well, based on the economy, the rents can go up or the rents can go down, right? Vacancy numbers can go up and they can also go down. Based on the economy, the taxes can go up, the taxes can go down. Contractors, how much they charge, it can go up, it can go down, right? So a lot of the economy, it could defer a lot of different things. Same thing with the amortization aspect. Well, the amortization aspect has a lot to do with banks. Do you guys think that banks get affected by the economy? Yes or no? I think that's an obvious yes, right? And same thing with appreciation. Does real estate values get lower and higher based on the economy? Yes or no? Yes, absolutely. Absolutely. So these are things that we need to keep in mind, guys, when we're calculating what makes a good return on a rental property. So I've broken down 4 different ways that an individual can get a return on a rental property. So what makes a good return on a rental property? You decide. It's up to you to make the choice, and it's up to you, right, to go ahead and figure out what you need out of these 4 things based on where you are financially, what are your financial goals, what are your assets, what are your liabilities, who are your dependents. There's a lot of things that we can think about here. And at the end of the day, guys, right, that's my goal, right? As somebody on YouTube, right, making a 14, 15-minute video on, on real estate, it's up to you guys ultimately to go ahead and sit down and really think about this stuff and put in the work. My job, again, is to at least answer the right questions, give you enough information so you could at least start that conversation. So again, guys, don't forget to click that subscribe button. Click on that notification bell as well, because we will be putting more content out like this where we talk about numbers and specifics, and you always want to be the first one to do that as well. Also, feel free to check out our book, 0 to 75units.com. I wrote it literally in a week, and you'll be able to get it done probably in a day. I always make the joke that you can get it done in one bathroom sitting. So it's actually detailing my very first step on how I got into real estate investing. So hopefully this video was helpful, guys. There's a lot of different videos that we talk about in terms of how to calculate numbers on a rental property. All the links should be in the description below. So again, guys, thank you so much for watching. Don't forget to subscribe and click that notification bell. And again, guys, much love to you. I'll see you guys in the next one.